Oh, this is going to be a fun conversation this evening, folks. Probably one of the most controversial videos that was largely inspired by a comment that I got recently on a video. And I think it really sprees into a broader conversation as this comment states, sold my my Canadian banks and most of my Canadian stocks, continued excessive regulation and taxation. The Canadian government isn't interested in creating wealth for its people. The Canadian economy is dead. It won't collapse. Neither will the banks or the real estate market, but there will just be stagnation. Now, this conversation, I don't want to focus as much on the comments as I do the broader conversation of just investing in general and the Canadian markets versus the US markets, how I've kind of positioned myself and how I feel about the current Canadian markets when it comes to dividend focused investing, because that's what the Canadian markets are largely derived from. And this can really boil down to a few simple comments that I have, and then we're going to review about a dozen Canadian stock portfolios that I personally pulled off Blossom, because so many of you keep asking me why I don't show my portfolio on Blossom, and it's more or less just because I don't have a Wealthsimple account to link to it, and my accounts are all over the place, and I don't know if I can share. I'd have to dig down on the app a little bit, but I think the realistic manner here is, what phase of your investing career are you in? You're either in the growth phase, the ending phase, and the retirement phase. Each of these phases will come with a different aspect of how you should be looking at your investments. And in the growth phase, you shouldn't really be focusing on dividend stocks, which the Canadian economy is largely comprised of, because let's be real, the Canadian stocks just don't grow that much. That doesn't mean they're not in a discounted value. And we can take a look at my own portfolio and get an understanding. And I think anybody that's been following this channel for a long time kind of realizes that I've never really put a lot of my money in the Canadian stock market. Most of my money has always been in the US. I mean, most of my biggest gains have come from the US, with the exception of actually, that's not true. I've taken on some speculations in Canada that have yielded some great results. It's just none of your traditional investments. It was never your banks. It was never your Enbridges of the world. It was way more speculative investments. But I recognize that a lot of the growth vectors come from the S&P 500, a lot of those tech companies, and I just always feel like maximizing that potential. Now, I also recognize there's a lot of overvaluation in the market, which makes me want to always lean a little bit more into the dividend side of things, which is why I have a huge position in SCHD. I think it's a little over leveraged. I want to scale it back a little bit by kind of scaling up some individual positions like Google, but still, I'm kind of just playing this balancing act, but still looking for outsized returns because I'm still very early in my investing career. Now, whereas with my parents, for example, my parents heading into retirement or in retirement, I would really not focus as much on the S&P 500 as I would SCHD and VDY and the Canadian banks, and because they're not looking for outsized returns. They're looking for cash they can get paid from a cash flowing business today, right? Which you're not going to get from companies like Google or Tesla. I mean, you got to really speculate when those stocks come back. You need a long time horizon because they could stagnate for a few years. I mean, there's a lot of speculation that comes into these different kind of investing philosophies, right? Especially if you're the latter half, because if you're the latter stage of your investing career, getting close to retirement, you probably don't want all of your money in kind of higher growth-based stocks either. You want to start prepping yourself and building out those dividend stocks, maybe perhaps when they're trading on discounts like they might be today, right? So the portfolios we're going to look at are going to be very dependent on these people's personal circumstances. I don't know what those circumstances are. Maybe you do. Maybe you follow these people on YouTube more than I do. I'm just going to offer some brief insight into what I think about these portfolios and just give an honest opinion here, because I think this is a very crucial conversation and deserves almost a course in and of itself, because I find a lot of people in Canada get country biased and end up really focusing on the Canadian economy, perhaps a little more than they should be, when we know there's just not that same kind of growth here. Dividends for life. See, I'd be just, again, depends on where you're at with your life. I love dividend stocks, don't get me wrong, but you can't argue that growth is where the real money gets made. And I don't think it's been as much in the Canadian economy these days as it might have been in the past. I'm really debating on going 100% VFE or VOO, S&P 500. Set it, forget it. Your thoughts? Yes, I'm going to kind of conclude down this a little bit. I don't know if I'd go 100% S&P 500 because, again, tech stocks, I think, have a lot of growth ahead of them. That doesn't mean they're not overvalued. That doesn't mean there's not going to be a lot of corrections. And again, this is why I like looking at SCHD and these lower half of the market that hasn't really recovered yet, as for some growth, just as a hedge, because I'm not somebody that shorts stocks. We got to recognize things are expensive and not everything is growing like NVIDIA is. But still, we'll come back to this in a moment here, folks, because Brandon Beavis, he's, I believe, the brand ambassador for Blossom here in Canada. And his portfolio actually surprises me a little bit with, I guess it's appropriate for the amount of risk that he's taking, but the mass amount of diversification. And this is something that I've stated a lot that always kind of puts me on edge a little bit, is when you start buying too many stocks. I don't mind people buying an individual stock portfolio, and we're going to see toward the end of this what ones I actually like when you're buying just a lot of individual companies. But when you're like over leveraging, like a lot of investors do, like 20 to 40 stocks, it just gets kind of rather excessive in my opinion, and I just don't believe you could ever manage this properly, because there's a lot of debates around Alibaba. He's got Tencent in here. We can kind of just take a quick scroll through. I've kind of screen capped these, and we can zoom in a little bit and just take a look. His top holdings, obviously Google, Tencent. He's got the iShares US High Yield Bond ETF, Alimentation, Couche-Tard, Adobe, Meta, Babbitt, BlackRock. He's got a few other treasuries in here, Canadian National Railway. It's got more of the banks like Royal Bank and Costco, Apple. A lot of these are great companies. It's just a matter of, again, the amount of companies in here and the lack of concentration, especially when you get toward the bottom. It's like, why even hold 1% of Suncor, right? Like, why even hold 0.8% of Johnson & Johnson? Like, you can, again, might as well just buy an ETF that's going to auto-weight this stuff, because it just seems a little bit inappropriate for me personally. Maybe not him as much, but I just look at this and I get it. I like the global diversification. I like that there's some bonds in here. It's just not my style of investing, though I believe the guy's a great investor. And I don't know the accuracy of these times they actually inserted this stuff into Blossom, because you'll notice a lot of these YouTubers' portfolios are actually in the red, and that's probably excluding dividends. But let's take a look at Canadian in a t-shirt. This guy's another massive Canadian influencer here. And again, I don't know where these people are at the stage of their investing career, but I was shocked to see his holdings, because they're just interesting to me. That like RioCan, and I love RioCan as an income producer. Coca-Cola is amazing. Toronto Dominion Bank is amazing, but these companies severely lack growth. And to make and not even that RioCan has a huge dividend yield. I mean, it's got a healthy dividend yield, but its dividend doesn't grow. The stock doesn't really grow. It's more of a cash flow for today sort of a thing, whereas at least Coca-Cola, you're getting a little bit of dividend growth, but even Coca-Cola doesn't really have a good Geiger or a good, dividend growth rate over the last 5 years. It's kind of fallen off, right? So I'm kind of shocked that these what look like very experienced investors are very leveraged in stocks that, again, I'm not a financial advisor, but I wouldn't really advise somebody to make like the upper positions in their portfolio, right? It's nice to see that he's got the S&P 500 in here, but it only makes up 5%. He's got Iron Mountain that he's done very, very well on in here. Iron Mountain I've always been fascinated by. He's got Enbridge, Procter & Gamble. He's got Smart Center. So very, very dividend centric. But again, there's companies in here that I think I'd rather core focus as dividend stocks and make them much larger positions, like McDonald's perhaps. I mean, there's some good ones in here. It's hard to say like what ones you'd want to make your core holdings, but when you're buying mostly individual stocks, like why not make Microsoft, this massive software conglomerate, a much larger position? Because you can see it's up 61%. But the fact of the matter is if you haven't leveraged up in it and made it like a serious position, RioCan isn't going to do much for you when, Microsoft's only 1% of the portfolio. Canadian Utilities, he's got VDY in here even, right? Like why own a lot of these Canadian dividend stocks when you could just own VDY? That's another thing that I'm very confused by. Like, I just feel like this portfolio, when I look at it, it's got Costco and XRE. They're very low weighted in here. He's got TELUS, Walmart, Home Depot. Like, I just feel like this is a portfolio of somebody that was buying stocks. They just kept buying things that they liked, but never like made a direct plan. Again, I don't watch this guy. I'm not trying to be judgy. I'm just saying there's a lot of stocks in this portfolio and they are all over the place. And they're very like weirdly weighted too. Like some of these don't even make up 0.1%. And I just have a hard time understanding, like, were you just throwing money at random things as you kind of came across them and decided to never sell the things that you bought at all, or like, concentrated or leveraged? We're going to get into a more controversial portfolio that I'm just not the biggest fan of. And this is probably one of the most controversial YouTube channels, I think, when it comes to dividend investing, which is the Passive Income Investing channel, who's also on Blossom. And his portfolio honestly blows my mind because it is very leveraged into my least favorite kind of investments, because all of these tend to very lackluster performance of the broader indices and tend to always underperform. And there's very few option ETFs that I've seen that have outperformed, but we've got everything from QQQY, I think, to, we can take a look at the list here and just kind of get an idea of like, we'll take a look at the top one because it's 16% of his portfolio, but you got everything from like the Hamilton Enhanced US Dividend ETF, HDIV or F, some of the Harvest diversified ones, real estate and e-commerce, all of these. And this guy is very centric around some of these option ETFs because they maximize income. But again, maximization of income comes with two big variant problems, which is you're not getting the upside of the performance of these companies because usually you're not owning a full position in the stocks. And the second thing is they come with exuberated fees, which we can obviously see with this Defiance ETF that he holds, that, the distribution rate, which God makes no sense at 40%. The 30-day SEC yield, however, is 3.52%. I guess is this monthly distribution? Now, is it the 30-day or is it the distribution rate? I mean, these things get very confusing. I'd have to look it up if any of you have actually held this ETF, the NASDAQ 100 option income ETF. But again, you're paying pretty significant fees at 1%, which is definitely on the upper end. And again, I don't know anything about this ETF, but when I look at the since inception date, I mean, we're talking about a 7.7%, total rate of return since inception, which only is dated up till basically of 2023, so the end of the year. So it hasn't taken into consideration this month, but still, again, 7.7%. It's not terrible by any metric, but does that include the fee? Because if you wipe off another percent, that is not the most, a desired return that you can get when you're paying some management to underperform the markets, right? So again, you can like option ETFs. It's purely your option, your opinion. If you're into income and cash flow, by all means, but I am truly just a metric guy. I believe the numbers matter. I believe if you underperform the market for long periods of time and you're not in a retirement phase, you're just not cash flow focused, it's just scary to me because I just feel like people leave so much on the table during one of the most innovative times in history, as far as we can tell. But Zach Hardley, this is kind of another interesting YouTuber that has a very unique portfolio to me. And the reason I say that is because this guy seems very young. I don't know how much money he has or if he shared his portfolio, but the fact is he's got 37% of his money in cash. And and he's got most of his money between these option ETFs as well. Which I find very intriguing because I just don't understand this positioning when the markets were in such a shitter the last year. And if you just bought the S&P, you could have been up like 15 to 20% if you were just buying from like not even a year ago, right? Like if you just cost average your rate of return, because I just can't see you getting that off cash, right? And this huge amount of cash is going to be meaningless when these interest rate cuts come. In fact, you can't even kind of get the same yields you could have, at the peak of the interest rate hype. Like, I mean, even now you're not seeing the same interest rates that you could have gotten, right? They're still good, but that's going to slowly disappear. And I just feel like you're going to be left with a lot of money in your hand and a lot of like lack of performance, because we can see his all-time return just doesn't look appealing. That probably doesn't take into consideration growth or dividends, I would imagine. I don't know how Blossom calculates if it's total return or if it's just capital gain return, but this is just so intriguing to me how you come up to this decision to just buy option ETFs and have mostly cash in a market environment where things were just so suppressed. Because like I said, I positioned myself out of individual stocks largely out of fear and volatility and earnings, not really knowing where things were going, but I could not ever be out of the market. Like, I'll let the S&P work it out, but there's no way I could ever sideline my money because, again, we just went through it. I'm making lots of money now because I'm realize that the markets over time tend to do pretty well. So let's look at Mr. Financial here. This is another bit of a smaller YouTuber, but I do respect the smaller guys. I think this guy's been around for a while. I've never watched his videos. I can just tell because I think in his description on his Blossom that he might be a bit older. He said he's been investing in dividend stocks for some odd, what is it, like 8, I don't know how many years, a while. I'd have to double check. I don't want to quote anything. But again, another really interesting portfolio. He's got some stocks I haven't really looked at, like the Capital Power Corporation, RioCan, First National Financial, Bank of Nova Scotia. Seems very financial focused with some utilities, I guess. RioCan. Again, this portfolio does more or less resemble like a retirement portfolio, in my opinion, to some extent. Because again, let's just take a look at his bottom holdings and see what his other stocks look like. He's got Enbridge, Pembina Pipeline. This very represents a lot of the Canadian economy by the looks of it. Let me just pull this up here real quick so you guys can see this. You got BCE, Manulife, Toronto Dominion Bank, Brookfield Corporation, Canoe, that's like there's another income ETF, Goosey, MCAN Mortgage Corporation. MCAN is one I've talked about a lot. It is fascinating. I'm watching that one like a hawk. I really find that one interesting. It's got the S&P 500 at the lowest possible weighting, right? So I'm very intrigued because this guy seems like he might be one of those guys that's in a retirement phase. This very much to me looks like a retirement portfolio that may be slightly over leveraged in companies, because I probably wouldn't put 10 and 14% of these portfolios between those two stocks like RioCan and Capital Power Corporation. Let's just take a look at Capital Power Corporation, because I've never really looked into that. But I mean, the performance doesn't look that stellar. It's got a 6% yield, so we can kind of see the appreciation for why he'd be buying it, but it is down 30%. It looks like it hasn't had the recovery yet. It's got a great low PE on it, and it looks like their last earnings was pretty decent. So perhaps it could be a value play. It looks like it's had long-term growth. I mean, there's nothing wrong with a stock like this. It definitely looks very intriguing. Let's just take a look at the underlying assets here real quick. So, I mean, they've got good growth. Total assets at about 10.1 billion. About 7.6 billion in liabilities. So definitely a higher liability. For some reason, their cash and revenue exploded. That could have been a sale or something. You'd have to try and figure out what caused such a massive run up in revenue over that last or through 2022, but over the quarters here. It's definitely an interesting stock to look at. It looks like it's been crushing some of its quarterly earnings. But again, I don't know if this is a stock I'd make that large of a position. What's the payout on this guy? We got a payout ratio of held by institutions, about 53% payout. It seems like a solid stock, right? I'm just curious I'll have to take a look at it. It's not a bad stock. I just wouldn't make it that big of a position all in all. We got one more here, and then we're going to take a look at some people that are not YouTubers that can definitely offer some fascinating insight, like Canadian Dividend investing here. And this portfolio on the other spectrum of being a smaller YouTuber out there like myself is, I think, much more of a respectable portfolio from my kind of perspective, because he's got almost 50% or at least 43% of his portfolio in the S&P 500. Again, having that US exposure that so many of these big Canadian investors just lack for some reason. And I don't know why Canadian investors are so fearful for buying over the border stocks, because again, that is where the vast majority of my returns have come from. And America is the growth beast on a global scale that, that's where all foreign dollars fled to. As we've seen, if you look up the US dollar, and considering the amount of inflation and printing they did, the US dollar is sitting at like a 10 or 15-year high. So this portfolio just primarily comprises of VDY, VOO. He's got cash in here at 11%, QQC, I'll have to take a look, and about 13% in other stocks. So very intriguing. I don't think I took as much of a video of this, but let's take a look and see what he's got in here. So VFE, VDY, the cash. He's got the Invesco NASDAQ 100 index. I'd have to take a look and see what QQC is, but if he's got a bit of NASDAQ in there, good for him. He's got Toronto Dominion Bank, Manulife, Canadian National Railway. So this is where I get a little confused, because it seems like he owns a lot of stocks that are already in VDY. Like, why hold TD or Royal Bank or TELUS and Enbridge when they are the vast majority of their holdings? BCE even. These are all just the VDY positions. Like, I would just concentrate them down and just put that into VDY, and then maybe buy some of the growth vectors that aren't in there, like Canadian National Railway. Power Corporation's great, also there. He's got VRE, which is another, I think it's the Canadian real estate one. He's got Tesla in here too, which is interesting. Of all the portfolios I've looked at, this is probably one that I would resemble a little bit more with, but I would just try and clean it up and concentrate it a bit more into the ETFs, because you're just basically owning the same stocks, which hopefully you're not paying fees for, but you're probably not, because you're in Wealth Simple. So let's take a look at a variety of stocks, and we'll get into some of these fascinating comments, because it seems like you guys have been going on a tear. But let's get into it with Samantha here. Samantha's got an interesting portfolio of individual stocks, and I can say, if she is just a Canadian investor, this is typically what I'd like to see in an individual stock portfolio. It is very well diversified. It is very quality focused companies only, and it doesn't seem to be dividend centric. So our top holding with 10%, again, try not to make one stock any more than 10% of your portfolio, I think is wise advice that I've followed pretty much through my entire investing career, except in the super early days when I had like no money. If you got $1,000, it doesn't matter, I think, if you own one stock, because it's just, one of those beginning portfolio buildups. But for a diverse portfolio, and I don't know how big this is, but Amazon at 10%, Apple at 10%, Visa, Alimentation Couche-Tard at 8%. You got MasterCard in here. So maybe a little bit concentrated on the financial front with Visa and MasterCard, but you got Costco, S&P Global. You got, I think, the Brookfield. Is that what the BN is? That might be the Brookfield one. I'm not sure what M stands for, but you got CP, CN, so the railways, and 16% and other. Either way, I love this portfolio a lot. I think if I was in a growth phase where I wasn't so index focused because of the scale of my portfolio, I would probably build something out like this. I really do like this portfolio a lot. Very quality focused in a lot of different sectors. I mean, even if a couple of those stocks go under, I think a lot of the other ones would do exceptionally well. We have one here from Miss G that I also find interesting, because it has a lot of growth in it on the Canadian side of the border, like CSU, which I believe is Constellation Software, which I believe is a heavily overvalued Canadian stock. But it has been the best growth stock that has ever existed in this country, I think surpassing Shopify at this point. You've got C&Q, and again, these are very concentrated, so I'd be a little more concerned, because you've got about 45, almost 50% of her portfolio is just sitting in these three stocks here, which again comes as kind of a concern to me when Constellation Software, C&Q, and CRWD are the mass. And again, I think a lot of these are overvalued. I mean, even Canadian Natural Resources, I mean, their revenue has been falling off a cliff. I don't know. I'd just be a little careful because I do like Costco. I wish there was a little bit more U.S. exposure in here from some quality names. So something to just kind of pay attention to. But that's just my opinion. I don't know where she's at. This could be an early day portfolio, and she's done a great job. It's up 28%. So by God, no means she's not doing terrible at all. Then we have Dividend Earner. This is another interesting portfolio. And I'm actually also very, very impressed with this portfolio because this would fall in line with, again, what I believe to be, if you're buying individual stocks, a very well-weighted in quality company focus instead of just broadly overbuying like Canadian and a T-shirt did. So you kind of get an idea between how weird it is that these non-kind of influencer, YouTuber-focused portfolios are very well balanced. They seem very focused. And these YouTuber portfolios seem very scattered for some reason. I don't know what the inflection or the correlations are to that, but still we have Costco at 12%, Microsoft at 10%. You got Apple at 9%. Like these three stocks alone, oh, muy bien. Like I think the beautiful thing to build a portfolio off of is a foundation. You got AbbVie in here, great for some healthcare. Google, National Bank, TD, Alimentation, Couche-Tard. I'm not sure what IFC is. I have to look. She's got Waste Connection in here, another beautiful overvalued stock, but a very foundational stock because, you know, these waste companies have been crushing for quite some time. You've got RBC in here and about 17% in other. So the vast majority of our holdings, I would applaud this portfolio because it's also very beautiful. You know, it inspires me almost to look at a portfolio like this as a Canadian because I think it's very well balanced. We got another one in here that I would say is probably one of my least portfolios I came across. This comes in, and I don't want to be mean. I really don't want to be like rude about it, but this is like Reddit degeneracy kind of portfolio, like gambling, like diamond hand kind of portfolio. And, you know, when I see a stock that's 31%, that's Nikola, after the dude went to jail and the stocks just imploded, Plug Power's in here, AMC. This is like Tilray. Come on, Tilray, really? You got to own some of those. I mean, this is like the most painful portfolio I've looked at. I don't see this one doing very well. I mean, would you guys remember Nikola? Oh my God, you take a look at Nikola stock today, and it's like, oh God, look at this dump. I don't know, like it's down 99%. All right, like I'm not trying to be mean here, but like, what is the aspiration of a company like this? You know, no signs of panic as Nikola gets second NASDAQ delisting warning. I'm like, you look at the news around these companies and you're like, you know, how is this 30% of your portfolio unless you've got like $100 and you're just YOLOing it? And hopefully to God, it's just in the positions and not into like options or something like that. Again, I'm not trying to be harsh, but again, you guys got to recognize what you're doing with the future of your wealth and your early retirement here, folks. Now, I want to talk about the future a little bit, but before I do, we're going to get into some of your comments and questions because there has been a conversation that has been going on the internet that I truly want to be a part of. And it's been a hard thing to stomach for me. And I've been looking at investments in a very specific industry, a very specific niche. There's only one publicly traded company I found that I think has the fundamentals to pull it off. And I'll reveal to you what that is in a second, because I think your mind is going to be blown with what I show you next. But let's just take a look here and see what you guys have to say, because what's crazy is that he is up all the time despite these bad companies. Is that Phil B with the positive on that last portfolio? Look at mine. Oh, you've got your portfolio on Blossom, do you? Joe Money Show. Yeah, we could take a quick review if it's easy to search, that is, because unfortunately Blossom does not have a desktop version of their app, so I can only really look it up on my phone. But if I put in Joe Money, is your portfolio going to come up, my man? Let's take a quick search here. I do not see it, unless let me put the Joe Money. But yeah, if you guys got portfolios and you want a quick peek at them, but I don't see your portfolio in here, so maybe I'm just wrong. Oh, the Joe Money Show, at the Joe Money Show. Is that how it comes up though on you know, the let me just see here, the Joe Money. I don't want to spend too much time, so I can't find it either that, or I'm just spelling it wrong. I'll have to come back around to it. Sorry. Yeah, that's the Nikola investor guy. Yeah, again, I think it's debatable if he's at an all-time high. It might be one of the other stocks who's got very limited money in it, but it's still, just because your portfolio is up, that doesn't matter when you're buying terrible companies. And I think that's the discrepancy between stupidity and like the reality of smart investing, is you can be an idiot and still get great returns, but you can only be an idiot for so long because again, look at the Reddit era. I mean, you could have bought Nikola at any time before the dude got arrested and you'd be having a much different portfolio outlook, right? So you can still make very stupid decisions and be right, but you're not going to be right for very long because it'll bite you in the ass inevitably. How much does Warren Buffett Berkshire hold in U.S. Treasuries at 5%? I think it's half his portfolio, hedging for recession, protecting capital maybe. I think that's debatable. Honestly, Warren Buffett at scale, I just don't think. I'll make a bet right now, and I think it was funny because there was a really good interview when Charlie Munger was still alive. Warren Buffett was saying that when he passes on, he's going to put all of his money into the S&P 500, and it's going to be left over for his wife. And, he was really advocating toward the S&P, whereas Charlie's like, well, I still think Berkshire could outperform. I have a hard time believing Berkshire is going to outperform because of their lack of forward-looking. Again, the idea is fundamental investing doesn't exist anymore. There is no way to judge fundamental investing, and use it. NVIDIA is a good example. NVIDIA, if you looked at it an odd year and a half ago, it looked like it was a bubble because the stock earnings were declining dramatically and everybody was shorting it. Cathie Wood was selling it. And then all of a sudden the business tide shifted into AI and something unforeseen happened. And that's what happens in the world of tech and innovation is the world is evolving so damn quickly. You can't necessarily predict it with earnings and fundamentals. That way of investing is dead. And even Warren Buffett and a lot of investors pointed out that you cannot go back to those old school books, the idea of buying cigarette butts in a time where there were no public markets on the internet. Warren Buffett started investing in a time where you could buy cigarette butts and people didn't even know they existed. It was an untapped aspect of the market. But now everybody knows everything all the time, all at once. So you can't use those old school books. It's what I always think is ignorant when people are like, oh, read this book or read that book. It's going to teach you everything you need to know. And it's completely irrelevant for today's style of investing, right? So I don't think it matters that Buffett holds a lot of cash. I wouldn't hold a lot of cash. I think you missed a lot of opportunity to buy dips as Warren Buffett did through the pandemic, as he did through the 2022 crash, as he did through much of the tech run-ups that have been going on for eons. The only good decision they made was Apple, right? But I mean, you got to admire that they've missed out on a lot of return and they barely have been outperforming. I don't even think they are outperforming the S&P right now. I think if you look at the 5 year, it's been a pretty break even between the two, and the S&P with dividends, I think, have outperformed. And I can't foresee with the stocks that they're buying that they're going to keep up with tech companies, especially with what I'm about to talk about. Any Canadian dividend portfolios is the same, 20 or so stocks. Pick whatever, it's all the same. I 100% agree. And again, you're just not going to see massive growth. Don't get me wrong. I think we're going to get an initial growth phase on an interest rate cut cycle. But after that initial quick return, it's all going to be dividends. And we're going to be lackluster like we have been for quite some time in a lot of the bigger Canadian stocks like the banks, just because of new tax regulations and bullshit. I mean, it's just a fact of the Canadian life. Our government is, unfortunately, and I don't want to be political because I don't care about liberals, conservatives, NDP, you name it. I don't care. It's just a matter of there's a lot of lack of capitalism, I think, built into our businesses at this point. I think it's more or less about the green future and how, propping up a lot of things and deficits that we took on. And it's just less focused about, hey, like maybe if we just convince people to invest, maybe if we just kind of, tried to make our companies grow at a faster scale and give them that like the US is very capitalistic, right? It's bad and it's good because I think if you just inspired people to invest, you could change an economy very, very quickly just through the growth of business, right? Now, obviously, there's going to be wealth diversity and, an expansion between the rich and poor. But I think just getting people to invest is a start. The Canadian, not that it matters here as much. The Canadian Investor Podcast said it best. Canadians are too home biased and love their dividends way too much. They aren't wrong. It's a good point. Again, I'm not trying to shit on the Canadian economy. I like I said, if I was retiring tomorrow, I think Canada, if you want cash flow, if you want like a great retirement, again, people shit on the healthcare system, but if you've ever been in a dire need, and I have been to the hospital quite a few times in the last couple of years, one of my very close friends passed away from cancer. I have been in and out of the hospital for so many damn reasons, and I have a lot of respect for what the healthcare system did for those people without putting their families into a very dire financial need. So I love Canada. I think it's a great place to retire. You just don't have to live in the most expensive cities like Toronto or Vancouver. But I think Canada has a lot going for it if you're in a retirement phase. But if you're not in retirement, I would just not focus as heavily on the dividend side of the Canadian markets. I think the portfolio from Zach was just a small dividend portfolio. Yeah, again, these people might just be showing what they're showing on Blossom, and it could just be a Wealthsimple account. Maybe they have other brokerage accounts. I don't know. Again, these are just my perspective. I don't know if they're retiring. I don't know how much money they have. I don't know anything about them. So these are just my personal opinions for where I currently sit in my kind of investing career. It's the fire bros who want cash today and not growth. I can't stand covered calls. Thank you. Thank you. Thank you. I don't know how often people have to crap on covered calls before people wake up to the reality that they are not really great investments. There are some. Don't get me wrong. I've seen one or two that I honestly think were great, but it's only because they were hedging the Canadian dollar. And they definitely outperformed because they were US focused Canadian covered call ETFs. But again, Canadian dollar hedge, so they crushed it. I'm really debating. So again, we'll get through one more comment here, and I want to talk about the future of this stock and what I'm most interested in for growth. As many of you know, Google, but I got another surprise. You worried about the government taking advantage on the banks? The banks will outsmart. Yes, I think that's a good conversation to have. I think the banks will, but you have to understand, like, the banks have been doing very maniacal things, right? So look at Royal Bank. I think Royal Bank is probably the preeminent best performing bank stock for a reason, because it's only focused on the Canadian economy. And unlike the US, the Canadian economy has been growing on the things that make the banks the richest, which is real estate, and the Canadian economy with immigration. So they had those two major facets for them. But the problem now is, they had to get very kind of greedy with the way they were making money. Like, you remember when banks, if you used your debit card and you didn't have any money in your account, it would just say, hey, you have no money, you can't use it. And now instead they made it like a Visa card where you can go negative in a savings account, which makes no damn sense, and then charge you a non-sufficient fund fee for it. That is very maniacal against the poor, and it affects the poor. And it's like, there's no accounts you can get right now that don't charge minimum fees without having minimum deposits, like 3,000. Most of my bank accounts, you have to have 3,000 to 4,000 minimum if you're not, to avoid any kind of monthly fee. Like, they pry on the poor, and it's kind of sad, and I get it, but they're cracking down on all of that. Say goodbye to everything I just said. They're going to get an extra 1.5% above like a 500 million in cash, and they all make like 10 plus billion a year. I mean, like, they're going to get hindered. Like, they're definitely going to get shit on for a while. But again, they're cheap. And I think they're going to start to recover coming out of the loan loss provision era. And so long as you don't think real estate's going to collapse, the banks will be fine. So it's just a matter of a waiting game for earnings to recover. And you'll get a good bump. You'll get a good return. You'll get a good high dividend yield locked in. But outside of that, I'm not seeing like 100% gain or anything anytime soon, like you're going to see with companies, perhaps like Google or some of these other growth vectors. So just keep that in mind. TSLY, bro. I've been hearing that one a lot. I agree with you. I'm just surprised he is up. Yeah, Nicola, the investor guy. Anyways, so let's talk about the future of stocks here, folks, and what to anticipate, because I think I've been hearing a lot of investors. If you watch Dumb Money, I've been very enthralled by this topic because I work personally with companies right now that are building robotics for factories. They're automating everything from forklifts to traditional things used within warehousing already. They are already automated in AI operative. If you've ever watched videos of shipping yards, there is so much automation built into shipping yards today. I don't think people recognize the reality of what's coming, but there is one company that I looked at and my jaw kind of hit the floor, because I just don't think people truly appreciate the scale at which robotics are coming along right now. And I remember when I was always telling you, like, why does McDonald's not have a robot flipping its burgers and doing all this stuff? Well, guess what? They're testing that crap right now. My mind was largely blown watching a robot work the line as a meal prep at McDonald's. And Tesla is not the only company that is very far ahead in these kind of robotics. And like I said, there is a lot of investment in vehicles that I'm currently looking at to try and figure out like how you get ahead on this, because I don't think people appreciate the scale of how bad this is going to come. Right now, this company that you're looking at, they just did a partnership with BMW to manufacture these robots. There are companies making deals right now to start making these things at scale. This is going to come like a freight train. I'm telling you right now, people think this is a lot farther out than it is. I think this is coming in the next couple years. I think it is very likely these are going to become marketable products in the next couple years. They might not be fully driven by AI, but they can be predetermined to do things like they are already. And like I'm seeing it be done. So I don't think people recognize the growth that is still ahead of the economy, because my God, when you get these things taken away, so many factory are like, so basically there's going to be a supply deficit for workers when it comes to a lot of the economy, especially in shipping and warehousing. They're already talking about the deficit that exists. There's going to be a lot of slumps where the economy needs workers. I mean, think about it right now. The reason we haven't been in a true recession is because the job market requires so much demand today. that demand is going to start shifting dramatically thanks to companies like this and AI and software. And as mentioned, I really want to be investing in the companies that not only own the software, but obviously own these systems like Tesla, right? So I've been really debating on the Tesla play, but I am horrified of the stock because, when you have a guy like Elon Musk that I have nothing against, but when the dude wants to own 25% ownership and says he's not going to build AI properly for the company unless he gets 25% ownership, whether it's through stock compensation and milestone being reached, which is fine, do it by all means. I think, Tesla's the best investment for these kind of things. They have the best balance sheet. They have a long runway and they have a lot of branding power. I just wish it wasn't so damn volatile and so expensive. So I'm just looking at how I want to play this industry, but this is an industry I've been desperately trying to figure out how to get into my portfolio sooner rather than later. And yeah, I really hope you guys are not too heavily focused on these dividend stocks and missing out on these software plays and these AI. Again, I just don't think people truly understand, this isn't sci-fi anymore. This isn't a dancing robot on stage like we saw from Tesla a couple years ago. This is unfathomable even you remember Boston Dynamics, like those are primitive today. I mean, Boston Dynamics, if you guys remember these robots, these were the pinnacle, right? Back in the day. Where are they at? Dynamics. I can't even spell this. My good. Let me pull this up real quick. Like, where's Boston at these days? Because I remember this was the pinnacle of robotics once upon a time, and then they're getting slaughtered now. Yeah, they have a robot dog. And they make some of these arms, which are obviously a big deal already in robotics. These arms are really interesting, but they don't seem too focused on the humanoid side of things. And even Amazon, right? Amazon's building their own robots right now. They're testing in their factories. Let's watch a quick video here. I'm curious to see how their dynamic robots coming along. Please accept cookies. God, yes, I need you to track me and sell me ads. Let's just take a quick watch. Where Boston's at today.
This video should in many ways look familiar to those who've seen our videos in the past, but it's meant to communicate an expansion of the research that we're doing on Atlas. So we're not just thinking about how to make the robot move dynamically through its environment like we did in parkour and dance. Now we're starting to put Atlas to work and think about how the robot should be able to perceive and manipulate objects in its environment while maintaining that characteristic high level of performance that we expect from Atlas. In order to do that, the robot has to be able to think. There's on board that are
so fascinating. When was this video posted? Even this looks pretty interesting. Let me just take a look. When did they post this one? A year ago. So it's pretty relevant, actually. It's very relevant. Yeah, that's pretty awesome. So you guys need to be paying attention to this stuff. This is why it's so great to invest in the S&P 500, because you just get auto-weighted so many companies that are working on this stuff right away. It's why I keep telling you every time I buy a stock, I will always be buying the S&P 500 on top of it in case one of the companies I pick kind of implodes. But my dream portfolio right now, as I've mentioned in the past, I've kind of gotten through this phase now of over paranoia, because when the market was dropping, I was shitting my pants for good measure. I didn't know how far these stocks could drop. Meta went to $90 a share. My wife had way more cojones than I did through it, but I didn't want to put all of our portfolios at risk just into these individual companies. So I just did what I thought would be the smart thing and just weighted all into the S&P and SCHD and hold tight. And it worked. It was great. We got a great recovery and we've seen a lot of the return, but now, I'm still young. I still have a lot of potential and I've got a lot of money just sitting in index and safe investments now. So I really want to start again, fixating on building about 15% of my portfolio. I'm going to say about 15 to 20, because I want to weight SCHD down as a security blanket just in case the bottom half of the market starts to recover like I think it does. I think those dividend stocks are going to do exceptionally well. So I do not want to give up that exposure, but I'm definitely looking at picking about 3 stocks to core focus it. And I've been really fixating on things like Microsoft. Google's definitely been an easy buy for me because I think it's just a great value play at this moment. And again, keep in mind, I will do a full update sooner or later with the combined portfolios of my wife's and mine, because I think it kind of brings into some relevancy behind, why I'm buying Google, because again, we don't have a lot of exposure to it right now. But I'd like to pick primarily for my portfolio 3 really core concentrated stocks that we don't already own. And Google's one of them. I'm looking at Tesla real deeply, especially if it drops below $200 a share. Microsoft can definitely be one of those, being a heavy software focused businesses, because software has margin. And this is just going to be, I think, one of the most fascinating couple years of our lives. I think, to be honest, I think people before, it's taken a while to get self-driving and some of these automations off the ground, but I think robotics is already off the ground. I think we're getting to a place where they're not only just, testing these things now and trying to build out the software for them, but starting to prepare for manufacturing. And when you start preparing for manufacturing, I think you have to appreciate that we're going to start getting to a level of scale here very shortly. And when I mean shortly, we're talking about 3 to 5 years. I think a lot of these plays might be between it's 2024, maybe 2028. I think we'll start seeing scale somewhere between 2028 and 2030, if I had to guess. A lot of people think 26, 27. I don't like being overly optimistic, but I can really recognize the reality that's about to hit like a load of bricks, because you have to understand efficiency and margin. Businesses just want efficiency and they want margin because they're all working for shareholders. And at the end of the day, you see greed in the market. Like, did you guys see the Loblaws CEO? I'll share with you a little bit of drama that leads to why people do horrible things for society. Again, capitalistic crap, you have to deal with it. But the Loblaws CEO drama is awesome, because if you guys don't know, and if you are like me, you are cheap, you are frugal. And when you go to Walmart or you go to these shopping centers, you probably, if you're like me, you're going to the dollar chip aisle, you're going to the what are we getting rid of today on discount aisles just to see if there's any good grabs on fruits or just drinks or whatever's there, right? So anyways, Loblaws came to a conclusion that I don't know if they have record-breaking profits. Yeah, I don't think people realize that it is costing Loblaws money when they get rid of stuff on discount. Because instead of you going in and buying something you were going to buy anyways at full price, you'd buy it at what they're not really making any margins on because it's going to spoil in a day or two, right? They have to get rid of it. So the CEO thought it would be a great idea to say, hey, forget broke people. Like, if they got to come in and buy something, why don't we just throw that food out and make them buy the expensive stuff? And then the dude was harped on as like one of the most evil guys in Canada, because the dude's a billionaire basically. And it was one of the most maniacal things a food company's ever done, especially in this high inflationary market where a lot of people are struggling, right? So yeah, it's very interesting. So you got to kind of take into perspective, this is how most CEOs think. They think about margin, they think about return. And when I can buy a robot for even $50,000 that can work a 16 or 20 hour day and charge for 4 or 5 hours or whatever it is, and work nonstop and don't talk back, and no break and no bathroom and no phone time and no smoke break and none of this crap. I mean, the thing pays itself off probably in 1 year's salary. I mean, you can quickly start imagining the scale and the scope of what this is going to do, probably to first and foremost manufacturing. And I'm not talking billions. I ain't talking hundreds of billions. I am talking about a brand new $1 trillion industry. And it is going to come like a train that I definitely want to be a part of in the next 5 to 10 years, because I want to retire early, and retiring early requires growth. So I'm not going to get that out of the Canadian banks, unfortunately. Robots are about neural network processing capacity. Tesla even had to develop their own neural chip nodes, as they couldn't get enough processing capacity. So yeah. So again, I think this is the real debatable conversation, right? So I think the robots are good enough. I've seen them. I know what they're doing. I get it. All you have to do is train it. For one thing, you don't need AI to do that. That's why Tesla right now, you see them folding the shirts and they're like, oh, well, that's not AI doing it. That's because they need somebody to train the neural net. And the only way they can do that is with data. So they'd have to physically manually operate the robot to do these tasks over and over and over again until it can systematically figure it out on its own. But you don't need that. Tesla's going in a whole nother direction, which is fine. And I think there's potential to that. It's just going to take a lot longer. Whereas you could easily take that robot today, just train it to fold a shirt or flip a burger and just do a few simple tasks that you'd be paying some guy $15 an hour to do, and easily replace his job overnight. And again, that's the reality of it today. It does not need to be like this fully AI autonomous thing. It just doesn't have to be. Obviously, I think that's the future, but that future is probably another decade out. I don't think that's coming tomorrow, but robots will be coming probably tomorrow because they're here now. I mean, there's no doubt about it. I wonder what some companies are that produce components for small modular nuclear reactors. That's another good question. I don't play commodities because I've been talking to a lot of guys about the commodity world, because I work with a lot of guys that are running massive exploration sites on uranium stuff. But if you guys have not checked out the uranium chart and you want to have your mind blown, again, I don't play commodities. I get nuclear reactors, but they're very expensive to run. You can buy things like Southern Company, I think, are a really good example of that. But I honestly can't wrap my head around what's going on here. And I've talked to people about the supply and demand metrics, and I have a few ideas of why this is happening, but this isn't going to be sustainable forever. And I don't know how far this runs for, but there's a lot of companies that are exploding. Like I think UEC is probably another good uranium company, Uranium Energy Corp. And you look at this, right? Like you look at how crazy parabolic this is going. I mean, it's up 188%. No one's talking about this industry, but I mean, if you want growth, uranium's probably one of the more interesting. Forget lithium. Uranium's where the real money's at right now. Save money wherever you can. I agree. Doesn't talk back. No bathroom break. Sounds like a perfect wife. Don't say that out loud. But can the robot make sandwiches? That's the real question. All right. Before the stream goes down a path of conversation that might be the wife's not listening in the background, hopefully. Oh God, Jesus Christ, guys. Anyways, this is going to be something I'll be making videos on. Don't you worry about it. But yeah, this is going to be a fun conversation and definitely a fun investing career because, like I said, I think these industries are largely underappreciated. And unfortunately, and not unfortunately, I just think if Tesla can drop a little more, I think it's the preeminent buying opportunity. But because a lot of these companies are still private, so they're harder to get money into. And I know some other ones. The problem with venture capital companies that are building robots that I work with, they just don't have the same liquidity because, again, the venture capital market was hit so hard. They're doing things today that are cool, but they don't have that scale, right? Like that robotics company, when you partner with a company like BMW, like that's where you start seeing manufacturing scale. Like that's what we need to see. Like how is this thing going to perpetuate into 100,000, 1 million bots and start executing on that? But either way, folks, what an enticing conversation this evening. And I hope you learned something and stay cool, stay awesome. And as always, I look forward to catching you in the next one. Peace.